With the highest number of young STEM graduates per capita in the EU, Ireland has the people and skills your company needs to succeed here. IDA Ireland, the National Investment Development Agency, can help you find and nurture the people you need to internationalise and thrive. Our talent is just one of the extraordinary benefits Ireland has to offer. Learn more at idaireland.com. Invest in extraordinary.
Introducing the all-new Adobe Acrobat Studio, now with AI-powered PDF spaces. Do more with PDFs than you ever thought possible. Need AI to turn 100 pages of market research into 5 insights with a click? Do that with Acrobat. Need templates for a sales proposal that'll close that deal? Do that with Acrobat. Need an AI specialist to tailor the tone of your market report to sound real smart in real time? Do that with the all-new Adobe Acrobat Studio. Learn more at adobe.com/do that with Acrobat.
Your next product launch is coming fast. Don't let billing slow you down. Legacy systems can't handle usage-based billing. That means your team is stuck gluing code together, piecing through spreadsheets, and running ad hoc queries just to figure out what to bill. With Metronome, you can roll out new pricing in minutes instead of months, whether it's usage-based, seat-based, or a hybrid model. Visit metronome.com to see how companies like OpenAI and Anthropic launch billing as fast as they launch products. That's metronome.com.
This is Bloomberg Daybreak Weekend, our global look at the top stories in the coming week from our Daybreak anchors all around the world. Straight ahead on the program, the Fed lowers interest rates, but will the data support more rate cuts for the rest of this year? I'm Tom Busby in New York.
I'm Caroline Hepker in London, where we're asking whether private markets are entering their golden age.
I'm Doug Krisner, looking at what's at stake when Australian Prime Minister Anthony Albanese meets with President Trump on the sidelines of the UN General Assembly.
That's all straight ahead on Bloomberg Daybreak Weekend. On Bloomberg 1130 New York, Bloomberg 99.1 Washington, D.C., Bloomberg 92.9 Boston, DAB Digital Radio London, Sirius XM 121, and around the world on BloombergRadio.com and the Bloomberg Business app.
Good day to you. I'm Tom Busby, and we begin today's program with a look at the Fed's 25 basis point cut to the federal funds rate this past week, what it means, and whether some upcoming data will support the 2 rate cuts the Fed has penciled in for the rest of this year. For more, we're joined by Edward Harrison, senior strategist and author of Bloomberg's Everything Risk newsletter. Fed policymakers, in a nearly unanimous vote, lowered the federal funds rate by 1/4 point this past week and signaled we could see 2 more rate cuts before this year is out. In your opinion, did the Fed make the right decision, and why?
Yeah, I think that the economy is slowing, and so that is the right decision just for insurance purposes, as an insurance cut. There was one member of the Fed who thought they were playing catch up so much that they should probably go with 50 basis points as opposed to 25. He was a complete outlier, not just in terms of the dissent. This is Stephen Miran, who is actually in the White House on leave while he's at the Fed. But he also was very much an outlier in terms of his projection for the interest rate at the end of the year, which he put at lower than 3%.
Which would mean several rate cuts of 50 basis points or more.
That's not what the rest of the Fed is looking at. And so I think, the thing that was most demonstrable is the fact that there was only the one dissent from someone who's very associated with the White House. All of the existing Fed officials went along with the 25 basis point cut, which would suggest that any attempts to erode the Fed's independence are likely to be stymied. And this is the first indication that that's the case.
Well, let's talk about what really drove this, and that is a weakening U.S. labor market. And boy, have we seen some kind of frightening stats in the last couple of weeks, like 911,000 jobs, a correction in the year leading up to March. What does this tell us about how the Bureau of Labor Statistics surveys are done, or does it tell us more about real weakness in the U.S. job market?
It tells us more about real weakness in the U.S. job market, because basically what the BLS does is they collect the data that's available to them at the time, and then later, based on other data like filings for taxes and things of that nature, they can update the data. And what they've done is they've updated the data from March of 2024 through March of 2025 and found that there were 900,000 fewer jobs that were created over that year time span than we had thought, which says that the Fed's rate cuts from 2022 to 2023 acted with a lag that was more severe. The act of those rate hikes rather from 2022 to 23 that was worse than we had anticipated based upon the initial numbers. So the Fed was basically playing with a lot of data that that wasn't correct, and so they're in the process of reevaluating, how weak the labor market is.
And that's not it. Not just those corrections, but black unemployment soaring under this president, 7.5%. Underemployment is rising. College grads with engineering degrees can't get a job. And it looks like right about now, we're going to start to see the impact of all those federal workers that were laid off back in April. Their 6-month severance deals coming to an end now.
You hit it right on the head, Tom. I think that all of those things are coming together in a way that show that the economy, just from the labor market perspective, is weaker than we had thought, and it will continue to weaken. And the average Fed official is looking at 3 rate cuts for the year. That is not only this cut, but the next 2 meetings for this year. And then they're going to continue to cut rates in 2026. And mind you, this is while inflation is above target at 3%. So that's how alarmed they are at the state of the economy, that even though the inflation rate is high, they still feel like in order to avoid a recession, they need to cut.
And inflation, now we're gonna get another read this coming week with August PCE, forecast to be 2.9%. That is well above the Fed's longtime target of 2%. But also, will we know, and when will we know, the real impact of the Trump tariffs on inflation? I mean, we haven't seen, and the Fed admits it hasn't been very bad yet, but is it coming?
Yeah, the question is when is it coming? From all indications, really, foreign companies have not paid the tariffs. What's really happened for the most part is the lion's share of the tariffs have been eaten by the companies. They've found ways to get their costs down and to keep their margins up, even though the costs they've absorbed the costs. But part of the reason that they absorbed the costs was because they thought perhaps the tariffs would be lesser over time. There would be rollbacks, but that's not happening. And so we're seeing increasingly that these tariff costs are being passed on to end consumers where they can be. And so we should expect some level of higher inflation between now and the end of the year, and probably even beyond that. So it's going to be an ongoing process, how long we get this new inflation. But it's clear that if we already have inflation near 3% and it goes higher, then it's going to be well above the Fed's target, even as they're cutting. And so that's the danger, and that limits how much they're able to support the labor market.
Well, we're going to find out about the economy with a final read on Q2 GDP out this Thursday and personal spending and PCE inflation data out on Friday. Our thanks to Edward Harrison, senior strategist and author of Bloomberg's Everything Risk newsletter. Well, next we turn to the U.S. airline industry, which saw a tremendous rebound in summer travel demand, but some carriers appear to be doing a lot better than others. For more, we're joined by George Ferguson, Bloomberg Intelligence senior analyst for airlines, aerospace, and defense. Well, George, let's start with that rebound in travel that we saw this past summer. How was it, and can that momentum continue for these carriers?
Look, I think what we saw this summer is continued strong demand for those premium travelers. And so, we heard a number of airlines give us updates as they went into the Morgan Stanley Laguna Beach conference. And, really, I think what we heard is improving demand. And we did hear some of that improving demand even at the low-cost carriers. Although I think this challenge is they still have so much excess capacity. It's going to be hard capitalize as much as they'd like on it. But yeah, I think really, the story that we got coming out of Laguna is, and we're seeing in the broader economy, is that the well-heeled consumer is continuing to, take their vacations, fly to Europe, spend a bunch of money, and that's been good for the United Delta's Americans. And we're continuing to see there's probably too much capacity in the low-cost world. And we've seen bumpy results at companies like Spirit, which declared bankruptcy again, Frontier, JetBlue. Again, all indicative of some of the weakness down in what I'd call maybe the basic economy traveler. So I think this summer sort of reinforced that trend. 3Q is always a great quarter, not quite as good as 2Q for airlines, but two of the best quarters for them. We're hearing noise about more demand in what they call the shoulder seasons, 4Q, 1Q. So I think, look, we'll really see how well airline demand is holding up as we get into that 4Q and 1Q season, and people really have to want to get out there and travel and have a full budget to keep going. But again, I think the wrap is, that the well-heeled travelers, came at it again this 3Q, had to get their vacation in Europe, spent up for some premium seats to get across the pond, and it's probably going to help out those big full-service carriers.
Right, the big legacy carriers. But let's talk more about the ones, you said Frontier, JetBlue, and Spirit, which again filed for bankruptcy, still flying. But what happens? Who is going to benefit when Spirit finally winds down? And it looks like it will, unless somebody rescues it. Who's going to benefit? Is it those other carriers, or will the big ones?
So, I mean, look, I think everybody benefits, right? The big full service carriers, again, American, Delta, United, they have been subsidizing, let's call it some of that back of the airplane demand, some of that basic economy demand with their nice premium income. And so if they don't have to subsidize as much, that's obviously going to help them. But I think the real benefactors are going to be the low cost and budget carriers, right? And so I think you'll see that ripple through the JetBlues, the Frontiers, the Southwest more, even though Southwest model is going to sort of full service world. I think that's where you're going to see more of the gains. And look, I'll just say Spirit Airlines is relatively small. We don't see it going away yet. I was talking to my colleague Phil Brendel, who does distressed analysis right before we got on this discussion, and he's saying, look, Spirit could linger in bankruptcy for a while, but right now they are starting to cut routes and they're starting to cancel gate contracts and things like that. Bear in mind that they're going to cancel those assets where they're least productive, right? And so we're going to see a pickup again in the low-cost world from this, but they're going to take those routes that just weren't working well anyways, that maybe nobody should be flying to, or at least fewer people should be flying to, fewer airlines, and cancel. So I guess what I'm trying to tell you is I would moderate my expectations on Spirit alone. I still think more capacity needs to come out of this market, but it should, again, help the low cost more.
Our thanks to George Ferguson, Senior Analyst for Airlines, Aerospace, and Defense with Bloomberg Intelligence. Aerospace and Defense. And coming up on Bloomberg Daybreak Weekend, are private markets in the UK entering their golden age? I'm Tom Busby, and this is Bloomberg.
With the highest number of young STEM graduates per capita in the EU, Ireland has the people and skills your company needs to succeed here. IDA Ireland, the National Investment Development Agency, can help you find and nurture the people you need to internationalise and thrive. Our talent is just one of the extraordinary benefits Ireland has to offer. Learn more at idaireland.com. Invest in extraordinary.
For enterprise organizations, managing all your food needs is a tall order. But with EasyCater, you get a single workplace food vendor with the tools and resources to make it easy. giving teams across your organization an easy way to order from a huge variety of restaurants, all on one platform. All while consolidating your corporate food spend so you can control costs, streamline billing and payment, and simplify reporting. EasyCater, your business tool for food. To learn more, visit easycater.com/podcast.
From providing extra support during busy seasons to replacing vacant roles, you need Express employment professionals on your team. Express can handle everything from contract placements to finding the right full-time team member. Solve your workforce challenges when you let Express deal with the workers' compensation, payroll, benefits, and more, so you can concentrate on what really matters, growing your business. Go to expresspros.com. If you've never used a staffing company, here's how Express has helped businesses like yours to balance their workforce to meet production demands, reduce stress and burnout, which reduces turnover, access a local talent pool ready to work. For all types of jobs and a variety of reasons, choosing Express employment professionals is the move to make this year. With more than 870 locations, find the one near you at expresspros.com. That's expresspros.com.
This is Bloomberg Daybreak Weekend, our global look ahead at the top stories for investors in the coming week. I'm Tom Busby in New York. Up later in our program, a big announcement out of Australia. But first, private markets fast attracting exposure from investors seeking shelter from public volatility. It comes as some policymakers are tracking the situation with alarm, while others, including President Trump, are clearing the way for private domination. It's a discussion that'll likely be on the agenda as industry heavyweights gather in Paris for the International Private Equity Market Conference. For more, let's get to London and bring in Bloomberg Daybreak Europe anchor Caroline Hepker.
Tom, from as early as January this year, commentators and market watchers have been hailing the beginning of a golden age for private markets, thanks to vast pools of capital controlled by rich families poised to pour into illiquid assets. Now, 9 months into 2025, that prediction hangs in the balance. Despite industry giants, from KKR to Blackstone, targeting the world's wealthy to fuel the next phase of growth for private equity, economic circumstances and geopolitical uncertainty have challenged growth. There is a new source of capital, though, that may be about to arrive. Regulation and compliance have driven an unprecedented wall of US retirement money into private assets, according to a report from Bloomberg Intelligence. The top 20 US pension funds alone hold about $500 billion of private market exposure, the analysts found, with some having doubled their allocations to unlisted investments over the past decade. It is a development that could supercharge a sector with an already bright outlook, according to Tristram Leach, partner and head of investments for credit and hybrid in Europe at Apollo.
Clearly, we feel that the risk return is more compelling in private credit than in public markets, especially at the moment. And so the idea that you'd want savers to be denied the opportunity to benefit from the incremental return that's available seems to us, bizarre. So certainly making those products available to a broader swathe of the market is something that we feel strongly about, be that the wealth market or be that, working with institutions to make those products available.
How does that work? I mean, how are those conversations going about trying to get that expanded base opened?
We have been advocating for the availability of private credit and for the attractiveness of that as a product from the top of the house. And I think there's a pretty widespread discourse around how attractive that product is and certainly the relative value versus public markets.
Yeah, of course, the flip side to this is the discussion of systemic risk. And over the past year, you've had increasing discussion from the likes of Moody's and the IMF saying that private credit does pose this systemic risk. Is that fair? Are we going to see some funds collapse?
What's interesting is that what we just discussed was the relative value of private credit versus public credit looking attractive, and yet you don't see these same points made about public credit markets. We've noticed liquidity in public credit markets declining. So for us to focus exclusively on private credit markets as a place where all the risk is, doesn't make sense. Are you going to see funds a differentiation in fund performance? I think you are. The last 20 years have been an environment where there hasn't really been a very deep cycle in credit markets. And so you've seen very highly correlated performance across the private credit industry. I think you're certainly going to see an environment where you see dispersion in credit outcomes, and you probably also see dispersion in manager outcomes.
Apollo's Tristram Leach there. But despite that optimism, some are concerned. Officials from the US Securities and Exchange Commission have long called out the potential risks for markets going dark as companies favour staying private over a public listing, allowing them to bypass traditional disclosure and governance requirements. So is this the new age of the private market? What could the consequences be? It's something I've been discussing with Bloomberg's private equity reporter Sweta Gopinath ahead of a major gathering in Paris this September. So at the last IPEM event, so this is last September, we heard predictions of the end of private markets' golden era. Has that actually come about?
Unfortunately, yes. When interest rates were low, when financing was cheap, private equity was in this golden era, right? Because they could pursue all these leverage buyouts, they could return capital to investors, they could fundraise at a fast clip. All of that has died down pretty much, thanks to interest rates more than anything else. And also a difficult deal-making environment. It's not as easy to exit or monetize assets as it used to be. That's partly because the IPO market has been semi-functional for the last 18 months. It's slowly beginning to pick up now. Deal-making, exits via M&A have been difficult as well. So PE firms have not been able to return cash to their own investors, which means investors don't have cash to invest in new funds. It's sort of a vicious cycle.
But with US interest rates beginning to go down, do you think the bust might be temporary, or will we see a bit of a momentary surge or not?
Yes, I think, there are signs of a pickup. Lower interest rates certainly help. The IPO market is sort of beginning to bubble back up. M&A activity is gaining steam as well. So all of these are good signs. But at the same time, we have large LPs saying we don't want as many relationships as we used to have with GPs. We want to be really selective of the funds we invest in. So say, LPs who used to invest in 24 or 36 firms are now saying we're going to focus on the top 5 or 10, which means the largest firms, the Blackstones, the Apollos, KKRs, will still do well. But what happens to those in the middle or in the bottom rung of the market?
Bit harder there, maybe. In a regulatory sense, it's thought that Trump's deregulation drive has pushed private markets forwards. Is that happening in Europe?
It's yet to trickle down to Europe for sure, but the opening up of 401ks, the opening up of retail money to private equity, to private capital is definitely a good sign. Europe is making strides in similar direction. The UK government is also talking about opening up savings to private investments. Regulation is really moving in favour of the industry.
Yeah, there's been lots of talk of that, hasn't there, under Chancellor Rachel Reeves in the UK. Is there resistance to pension funds increasing private exposure, worries about what that means, transparency and so on?
There are worries, to be sure, because private companies obviously don't disclose results every quarter. There isn't the kind of transparency, as you say. But at the same time, in the UK especially, a lot of parallels have been drawn to the Canadian pension system. If you look at OTPP, the Ontario Teachers' Pension Scheme, for example, there's a feeling that, you have sort of these teachers out in the middle of Canada who have better pensions than anyone working in the City of London. So all of these efforts are sort of being made to equalize that, I suppose.
Well, it's taken them a long time, though, hasn't it, in terms of when that was set up and the amount of time and the size of the fund. So, you can understand, all of those caveats. But yes, maybe a slightly envious eye being cast at the success stories here and maybe how they can be emulated. In terms of European firms then, and also at this event, what do you think is going to be on the agenda? Maybe Europeans looking to try to catch up with the US? What's going to be on the agenda at the actual event, do you think?
There's been a lot of European exuberance this year, to be sure. That's because people are getting a bit fed up with the volatility in the US. There are also worries about investing in the US, about having money locked up in the US because of changing tariff and trade regimes. So there is a lot more positivity about Europe. People are talking about capital flows into Europe for the first time in decades, maybe. So European firms will really be looking to cash in on that momentum and change sort of that exuberance into actual fund commitments.
In terms of the specific funding needs for Europe, that of course is around infrastructure and defence spending. Can private markets fill that kind of gap? In recent days, Mario Draghi came back to Europe to give a big speech about his recommendations for the European markets, about opening up and trying to generate growth and investment in Europe. Do you think the private markets can fill some of the gap?
Yes, but private markets are certainly hoping they can and are pretty much betting they can. Blackstone is committed about 500 billion of capital to Europe on the whole. Apollo is spending about 100 billion in Germany alone. So on the infrastructure side, it's sort of, I guess, slightly easily done. But in defense, because historically a lot of their own investors, a lot of their own LPs have been prohibited from investing in defense assets, a lot of work is being done behind the scenes to change sort of wording and prospectuses and so on.
And in terms of whether the private markets are recession-proof or more recession-proof than other markets?
I guess they would like us to believe they are more recession-proof, but I don't know that it's true because a lot of these businesses at the end of the day are tied to the real economy.
And what about the concerns of regulators and the idea of markets going dark, as it were, with little information about these businesses? I mean, it's caught up particular investors here in the UK in the past, hasn't it? So there's also even this idea that President Trump has been talking about of for listed companies that they wouldn't have to actually report every quarter to Wall Street, but that maybe a 6-month cycle is better. So there's a lot shifting in that regulatory space, isn't there?
Yeah. Listed companies certainly do talk about sort of onerous regulatory requirements, and having to list every quarter obviously increases transparency, but it has its detractors as well, the practice, because there's this idea that companies sort of tend to meet analyst estimates and then bump forecasts just based on what analyst expectations are, that it's not really indicative of their underlying growth per se. And also when you talk to companies that are private and looking to go public,
yes,
the one thing they always cite as a hurdle is this regulatory requirement to list, to sort of disclose reports every 3 months. So I don't know if loosening that requirement perhaps might be helpful in terms of bringing more private companies public, in terms of bringing more private companies to the IPO market, certainly. But at the same time, lack of transparency isn't good. Investors need to know what they're putting their money in. So there needs to be a degree of financial disclosure.
So what do you think is going to be the outlook then for private markets? If, as you say, it's faced quite a bit of challenge in the last 12 to 18 months, what are you thinking about for the next year?
I think the opening up of private markets to retail money is a big boom sign for the industry. It just means more capital flowing into the industry. In that regard, that's very much a positive. Improving M&A markets are also positive because it means they can monetize assets quicker. But I think there's going to be a bifurcation in the industry where the big get bigger in terms of size, in terms of assets under management, struggle to survive.
Okay. Sweta, thank you so much for being with me today. Sweta Gopinath. That was Bloomberg's private equity reporter, Sweta Gopinath. My thanks to her. We'll have full coverage of all the deals, the conversations and activities from EPEM in Paris here on Bloomberg. I'm Caroline Hepker here in London. You can catch us every weekday morning for Bloomberg Daybreak Europe beginning at 6 a.m. in London. That's 1 a.m. on Wall Street. Tom.
Thanks, Caroline. And coming up on Bloomberg Daybreak Weekend, a major investment in defense spending in Australia. I'm Tom Busby, and this is Bloomberg.
For enterprise organizations, managing all your food needs is a tall order. But with Easy Cater, you get a single workplace food vendor with the tools and resources to make it easy, giving teams across your organization an easy way to order from a huge variety of restaurants, all on one platform. All while consolidating your corporate food spend so you can control costs, streamline billing and payment, and simplify reporting. EasyCater, your business tool for food. To learn more, visit easycater.com/podcast.
From providing extra support during busy seasons to replacing vacant roles, you need Express employment professionals on your team. Express can handle everything from contract placements to finding the right full-time team member. Solve your workforce challenges when you let Express deal with the workers' compensation, payroll, benefits, and more, so you can concentrate on what really matters, growing your business. Go to expresspros.com. If you've never used a staffing company, here's how Express has helped businesses like yours to balance their workforce to meet production demands, reduce stress and burnout, which reduces turnover, access a local talent pool ready to work. For all types of jobs and a variety of reasons, choosing Express employment professionals is the move to make this year. With more than 870 locations, find the one near you at expresspros.com. That's expresspros.com.
Parking shouldn't slow you down. ParkWiz gives every driver a shortcut. Book ahead, save up to 50%, and skip the hassle of circling the block. Park smarter, park faster. ParkWiz. Download the ParkWiz app today and save every time you park.
This is Bloomberg Daybreak Weekend, our global look ahead at the top stories for investors in the coming week. I'm Tom Busby in New York. Australia announcing plans to spend $8 billion in U.S. money on a defense hub to build naval ships and dock nuclear submarines. Prime Minister Anthony Albanese made the announcement this past week as Canberra seeks to bolster U.S. backing for the AUKUS pact. For more, let's get to the host of the Daybreak Asia podcast, Doug Krisner.
Tom, diplomacy will be front and center in the week ahead as the UN convenes its 80th General Assembly in New York. And it's there that Australian Prime Minister Anthony Albanese will be meeting with Donald Trump, and the two have a lot to discuss, principally the multi-billion-dollar AUKUS partnership. Now, AUKUS is a trilateral security arrangement between Australia, the United Kingdom, and the U.S. The aim here is to promote a free and open Indo-Pacific that is secure and stable. For a closer look at what's at stake, I'm joined by Bloomberg's Swati Pandey. Swati joins us from our studios in Sydney. Swati, thank you so much for making time to chat with me. Remember that AUKUS was signed back in 2021 by then President Biden. Obviously, we have seen a major shift in foreign policy under the Trump administration. What change has occurred that may affect AUKUS?
So since Donald Trump came to office, all of American allies have kind of been put on notice to increase their defense spending. And that was something that was expected out of Australia as well. In response, Albanese had sounded quite defiant and kind of sought independence in saying that this will be Australia's sovereign decision, what it does with defense spending. And then during that period, the US also launched a review of the AUKUS, and that led to question marks around the future of this partnership. And then in recent weeks, we have seen Australia making massive billion-dollar announcements to kind of, I think, satisfy the U.S. And it has also signed treaties around AUKUS with the UK. So it seems like Australia is trying to make those attempts and get that first meeting with Donald Trump since he came to power earlier this year.
Now, for Australia, there is the point here, I think, that we really have to tease out is that the U.S. will help develop Australia's nuclear-powered submarine fleet as a part of the AUKUS agreement. Is any of that in doubt right now?
Not right now. So I had some conversations with sources in Australia who are familiar with the Australian government's thinking, but also the American government's thinking. And it looks like the partnership will go ahead. The point of the review was really to reinforce the pact rather than unravel it. We don't really know a lot of the information, obviously. The Secretary of State and Defense Secretary in the U.S. have not publicly spoken about the intent of the review, but it does look like the pact will go ahead and Australia will be able to get the submarines at some point in not too distant future.
So from what I understand, the Australian government recently announced around $9 billion, that would be U.S., in related defense investments. And I'm wondering from the conversations that you have had with people there, whether that level would be sufficient to satisfy the Trump administration?
It may not be enough to satisfy them, but it is a step in the right direction as far as the U.S. is concerned. It's the intention. It's what they would like to hear. And it's also a change of tactic from Australia's side, where Albanese and Australia's Foreign Minister Penny Wong had earlier sounded a lot more defiant when it came to increasing defense spending. And that tone has shifted in recent weeks and months. So that will definitely be welcomed. And probably that is why we are getting that first meeting with Trump as well. So it's definitely welcome.
So we know the Trump administration is currently in trade negotiations with China. Can you give me a sense of the reaction that Beijing is having right now to this continued refinement of the AUKUS treaty?
The response from Beijing has not been quite vocal, I'd say. We had the China parade, the Shanghai Cooperation recently, where a lot of the country's dictators, Russia, North Korea, even Indian Prime Minister Narendra Modi were there. It was a show of weapons. It was a show of China's might, what it is capable of. And I think that is one of the ways that China is trying to show to the US and to the world to not take it lightly.
Can you give me a sense of what the Australian press is reporting as we look ahead to this meeting between Prime Minister Albanese and President Trump?
The Australian press has actually been quite critical of the US and Donald Trump in particular. Remember, Australia had an election in May when Albanese came back to power for his second term, and it was a landslide victory. It was not expected, so it was a surprise landslide victory. And so Albanese thinks that it is in his favor in terms of domestic politics to take a stand against Donald Trump, to sound more defiant in sticking up to what Australia stands for. And the local press has also kind of been reporting along those lines as well. However, in recent weeks, and especially since the Chinese parade, the conversations have also kind of tilted towards the need for a stronger Western alliance and for Western democracies to come together and fight the growing fragmentation that we are seeing in the world. I was at an event last week where Kurt Campbell, who is the former Deputy Secretary of State, was speaking, and he actually said that this meeting between Albanese and Trump will be the most consequential meeting of an American and an Australian in living memory. And he said that Albanese should use this meeting to talk beyond bilateral ties and talk beyond narrow economic issues to more regional defense and other global defragmentation issues. So that is what will be on Albanese's agenda as well.
Should make for a very interesting meeting this week between Australian Prime Minister Anthony Albanese and President Trump on the sidelines of the 80th General Assembly of the UN here in New York City. Swati, thank you so much for joining me. Bloomberg Swati Pandey there, joining from Sydney. Now, the global influence of the Trump administration goes well beyond the defense budgets of other countries. Look no further than trade policy and the use of those tariffs. And then there is the U.S. dollar, the world's dominant reserve currency. So far this year, the dollar is down by more than 10% against a basket of its peers. Yes, increased nervousness from global investors may be a part of that decline. But another aspect is the desire from the Trump administration to see a weaker currency. Stephen Miran, the newly seated Fed governor, has taken unpaid leave from his role as chair of the White House Council of Economic Advisors. And in Miran's view, The U.S. dollar is overvalued. For a closer look, I'm joined by Bloomberg opinion columnist Shuli Ren, who joins us from Hong Kong. Shuli, it's always a pleasure. Thank you so very much. I know you're writing about Miran's policy where the dollar is concerned. Fill me in a little bit.
He's definitely a dollar bear. He blamed the U.S. society's various economic problems, from the loss of manufacturing to wealth inequality to the overvaluation of dollar. In a very well-read paper published last November, he basically called He basically said that the dollar is overvalued and that it should not be acting as a reserve currency. And that's very much freaking global investors out. Like, what we are seeing is that the Fed was holding the rates, right, throughout this year until Wednesday. But the dollar, the broader dollar index has come down 12% already.
Do you think he's likely to have much in the way of influence while he's sitting on the Fed's Board of Governors?
He is only one of the 7 members. However, his rhetoric and the fact that Trump will get to decide on the next Fed chair do influence market narratives. And you are actually seeing it already. For instance, gold is on track to take over U.S. Treasuries as global central bank's biggest reserve assets. That's a sign that global investors are trying to hedge against the instability at the Federal Reserve. And also, what you are seeing is that global asset managers are increasingly keen to diversify overseas into international stocks, from Europe to Hong Kong.
So I mentioned that Miran is on leave from his role as chair of the White House Council of Economic Advisors, and we know a cornerstone of Trump's economic policies have to do with tariffs. And I'm wondering whether we need to talk a little bit about the tariff story as it relates to the dollar as well.
Well, and that's another problem, right? Like in the past, a lot of foreign governments, they ended up holding a lot of dollar because they were exporting their goods and services into the United States. But if the tariff war is set up, there is less need for them to hold dollar anymore. In fact, there will be, in the case of China, there will be few opportunities to earn dollar, right? That means that there is a lot of selling pressure on the greenback.
So if we step back and we look at the shift that is happening right now in global markets, is this a time where many, I will say, especially institutional investors, are diversifying, and perhaps some of that diversification is moving assets out of the U.S.?
I think we are already seeing that already. Europe and China have been doing very well this year. And it's also in part because the U.S. stock market has become very expensive, right? Like, if the AI boom is not showing up in the earnings in, say, 2026, 2027, then the U.S. stock market is just way too expensive. So there are incentives to move out anyhow.
So we know that when you are involved in the foreign exchange, it's always a pair that you're talking about, a dollar related to another currency. And I'm wondering if we can talk about the path of the dollar to the downside. I'm wondering what currencies will benefit on the strong side beyond the Japanese yen?
So if you look at emerging markets in the last couple of months, emerging markets currencies that offer quality carry trade, and I'm talking about those from Brazil, Mexico, and South Africa, they have been rallying the most. It's a sign that the carry trade is back, and the people are using the dollar as the funding currency to buy into higher yielding currencies.
Shuli, thank you so very much. Bloomberg opinion columnist Shuli Ren. I'm Doug Krisner. You can catch us weekdays for the Daybreak Asia podcast. It's available wherever you get your podcast. Tom?
Thank you, Doug. And that does it for this edition of Bloomberg Daybreak Weekend. Join us again Monday morning at 5 a.m. Wall Street time for the latest on markets overseas and the news you need to start your day. I'm Tom Busby. Stay with us. Top stories and global business headlines are coming up right now.
How many vendors does it take to meet all your organization's food needs? Just one. EasyCater, the workplace food platform that lets teams order from a huge variety of restaurants, over 100,000 nationwide, all through a single vendor. In addition to all that variety, EasyCater also gives you full visibility of your organization's food spend with invoicing, centralized reporting, and seamless integration with expense management systems, all on one platform. EasyCater, your business tool for food. To learn more, visit easycater.com/podcast. How can you grow your business from idea to industry leader? Bring your vision to life with smart business buying tools and technology from Amazon Business. From fast, free shipping to in-depth buying insights and automated purchase approvals, they deliver everything you need to achieve your goals. It's not easy to stand out from the crowd. Simplify how you stock up to get ahead. Go to amazonbusiness.com for support.
These days, AI can help you adopt better time management, but it can't stop colleagues booking meetings during lunch. But how about being able to easily adopt industrial AI to streamline your business? Siemens Accelerator helps you find the right AI providers and easily understand what they offer, so you can use modular solutions to quickly scale up and grow your business. That's AI for real, from the global market leader in industrial AI, Siemens. Learn more on usa.siemens.com/AI.